The World Cup might have taken centre stage recently, but of course the Iran crisis continues. The political effect, the economic effect, and the effect potentially on inflation is a concern for all of us. In this setting, grocery brand manufacturers are nervous about their volumes, about their shares in the face of private label, and in the face of retailer change and particularly hard discounters. I'm Richard Herbert. I'm an independent consultant working with Europanel. And in this series of short videos, I'm talking to a number of leading professors in the grocery field. The aim being to get their take on what's going on and what happens at such times, and of course to get some advice. So far, we've looked at volumes, private label, marketing mix, price elasticity, and retailers. And today I'm joined by Marnik Dekimpe. Marnik is Research Professor of Marketing at Tilburg University. His focus is very relevant: recession marketing, product harm crises, drivers of private label success, and the measurement of short and long-term, long-run marketing mixed effects. It's this long run that is our focus for today. Hi Marnik, as you were saying, good to see you, and long time no see, but lovely to see you, and hopefully we'll see each other again soon. But let's move on to our first area. Before we move to any specific recommendations based on your work, can you talk us through some examples of your work on short and long-run marketing mix effects and the implications for brand owners, brand manufacturers?
Okay, well, thanks, Richard, for inviting me and setting this up. I've done quite a bit of work on the distinction between short-run and long-run effects of marketing mix instruments. And when talking about short-run and long-run, the key thing to look at is the time frame over which that the effects will materialize. And we can, on the one hand, distinguish between the immediate effect, which is the effect that takes place in the same period that the action is taken. Think of a price promotion. You can think of a long-run effect, which is basically the effect that would emerge if you continue to see an effect over the coming periods, and an effect that does not die out, but that persists. For example, you may, with your price promotion, if you can attract a whole bunch of new customers that keep on buying your brand, by that promotion, you may basically have created a permanent uplift in your sales or market share performance. And then in the middle is what we could call the medium run, which is basically the effect that happens a couple of periods after the action has taken place. So in a promotion context, that could mean the immediate uplift, but also the well-known post-promotional dips. And if you then look at the net effect of that immediate uplift, of the post-promotional dip, of potential competitive reactions, of customers doing some repeat buying, if you look at those effects over, say, the next 10 to 12 periods, you basically can talk of a medium or dust settling effect. So it's basically the effect until the dust has settled, after your competitors have reacted, after your consumers have done repeat buying, etc. Now, in a couple of studies, I've basically looked at a couple of hundreds of CPG categories, a couple of thousands of different brands and their promotions. And what basically comes back over and over again, that if you're hoping to create a long-run effect, a persistent effect with price promotions, that very, very rarely happens. Maybe in 2 or 3% of the cases. However, if you're looking at the medium run effect, which is the effect, as I said, over a couple of time periods, and the net effect then of immediate uplift, post-promotional dips, competitive reactions, and so forth, then it's a bit of the glass is half full, is half empty kind of story. In the sense that for approximately 60 to 70% of the brands, you do find a significant positive uplift in your sales performance. That's the good news. The bad news is that this is not universal, because if there are 60% that have such an uplift, there is also 40% that does not have such an uplift. Though you may say that's not too bad, but what you always have to keep in mind with price promotions is that those price promotions apply to the entire customer base, so that you basically are selling your product at a lower price, not just to the extra consumers or to the extra volume that you sell to your existing customers, but also to the people that would have bought your brand anyway. So if the objective is to create a short-run uplift in sales, with short-run meaning a couple of time periods, then for 60% of the brands it's working. If your objective is to increase your profitability, then what you also should do is look at your profit margins and look at the size of your loyal customer base, because keep in mind, with price promotions, you're basically subsidizing also your loyal customers. If you then think that's for if you're looking at, say, individual promotions. The next question then becomes, what happens if you do those promotions over and over again? And then you should be even more careful, in the sense that if you do a lot of promotions over and over again, you're basically training your customers to look at the price attribute. Price attribute, which is where national brands may not be in the strongest position relative to the private labels. But with your promotions, you're basically saying, look at the price, and you're basically saying, look at an attribute where some of your strongest competitors may be better off than you are. Also, if you repeatedly do price promotions, you will basically also undermine your reference price. And you're training your customers to only buy, or mostly buy, when there is a promotion, and your sales under the regular price, where your margins are higher, may also be eroded. So depending on your objectives, that may be a good strategy, maybe a less good strategy. It also depends on what category you're in, what are some of the brand characteristics of your brand, or your big brand, or your smaller brand, and so forth. But on average, for sales increases, for a majority it works. For profit increases, I would be more careful.
Yeah, I think that links us very nicely into the second question, which I think we can then bring back into more of a conclusion for activity. And that second point is about private label. We've seen private label growing almost continuously in share for a very long period of time, and obviously in inflationary times even more so. Do you think there's a limit to how far private label can go? Is there a ceiling level, do you think?
With Katrijn, we also had a session with, I recently did a study using some recent econometric techniques, and where we looked for across more than 50 different countries, across more than 60, 70 different categories per country. So in total, more than 3,000 different CPG markets. And the answer is, yes, there is a ceiling effect. That's the good news. The bad news is that ceiling has not yet been reached in many of the markets. So if you ask, is there still, in most markets, is there still a growth in private label share to be expected? The answer is a definite yes. Will the increase go on indefinitely? Then the answer is no. There is some kind of a ceiling, and we estimated that ceiling for all of those different markets, and there is quite some heterogeneity. For example, in the UK, that ceiling is almost reached. I don't see much more growth happening in that market. However, in other markets, also within Europe, like countries like Portugal, Spain, Italy, there is still a couple of percentage growth to be expected for the private label shares. In regions like South America, I don't see any indication that private labels will quickly take up there. So that level or that ceiling is already almost reached and at a very low level. So it really depends on what country you're looking at. To complicate matters somewhat more, also within a given country, there is also some variability in terms of whether there is still an increase to be expected. And of course, being an academic, if you say there is heterogeneity and if you say it depends, then you start to look at what can explain those differences, and can you identify certain countries, certain category characteristics where the expected percentage point increase is higher or lower than in others. And then fortunately there are certain country characteristics like retail concentration, cultural characteristics that help explain this, but also in terms of the category characteristics, like there is a higher increase still to be expected in hedonic categories than in more utilitarian categories. And then the good news is there are certain things that brand manufacturers can do in order to limit that private label growth.
Yeah, I think you said the UK has probably reached its highest level. However, that's 50% or over 50%. And I remember many years ago talking about Spain, where at that time it was like 11 or 12%.
Yeah.
But then Mercadona happened, so now it's up in the high 30s, 40% level. So even in Latin America, you could potentially see that sort of thing occurring, but maybe not quite yet. But anyway. Yes. Okay, in those contexts then, what advice would you give based on that to brand manufacturers to either halt that growth or at least slow that growth over time so that it becomes more manageable? And is there a difference between large and small brands, I suppose?
Yeah. I think I'll structure my answer a bit along three recommendations. The first one that I would say is keep on innovating. Okay? In the sense that, yes, I realize that private labels can then imitate, but basically, if you keep on innovating, you should try to always be a little step or a few steps ahead of the private labels. Though keeping in mind that innovations can be imitated, especially if they are incremental innovations, the recommendation would be to keep on investing in more radical innovations that take more time to be imitated than, say, the incremental one. Also, when the economy is bad, when you're in rough water, like with a recession, with a high inflation period, then it becomes especially critical to keep investing in R&D so that when the market picks up again, that you're ready to introduce your real innovations ahead of the private labels, because when the consumer demand starts to pick up again, then maybe also the ideal time to be ready with something that the private label competitor does not have yet. So first advice is keep on innovating. Second advice is, as I already mentioned, don't fall into the promotion trap. So don't just go for the quick fixes, that you try to increase your short-run sales a bit with a lot of promotions, because as I mentioned, you're basically saying to the consumer, hey, price is very important. The consumer looks at the price and then notices that oftentimes the others are cheaper than you are. The third one may be a bit more provocative, which is that research both by myself and by Jan Benedict Steenkamp has shown that if you want to sustain the strength of your brand, if you want to keep having a strong brand, that the key marketing mix instrument is to have a strong distribution network. That distribution is the one of the key marketing mix instruments. Now, how can you increase your distribution? Okay, so one option could, of course, be to start selling through the internet. But we all know that the fraction of CPG products that is sold at the moment through the internet channel stays fairly limited. An alternative is, why not go to sleep with the enemy? So why not go distribute your national brand through the hard discount channel? And the hard discount channel is basically known for its strong focus on private labels, and in countries where the discounters are growing, typically private labels are growing as well. However, in a recent study that I did, we showed that for the vast majority, the very vast majority of brands, if you sell through the hard discount channel, both your sales go up, but also your brand equity benefits from it. Now, there is a debate or a concern among many brand managers of what will happen with the image of my brand if I start selling through the hard discount channel. What we found is that the net effect of having a higher awareness, more touch point with your customers, and perhaps the somewhat negative effect on your image, that the net effect of those two opposing forces is, for the vast majority of brands, is positive. Now, if you then start selling through the hard discounter, first you get more touch points, but you're also undermining a bit their business model, in the sense that they will no longer be only focused on private labels, but may also be willing to help your own brand's performance. Yeah. So I know that this may sound a bit counterintuitive, but my own research, other research, has shown that basically on average the effect is positive if you increase your distribution network also along those lines.
Absolutely, and that's some of the examples I've recently been looking at as well, and also fits in with the discussion I had with Katrijn, that discounters will also have a ceiling of how far they can get, so differentiation is going to be needed as part of their long-term business model as well.
Yeah, exactly.
Okay, Marnik, thank you very much. That was very interesting as always, and thank you very much for your time, and good to speak to you again, so thank you.
Okay. Thank you, Richard. Nice talking to you. Bye-bye.
Thank you.